Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an amazing guest in Mr. Paul Stout. Paul is the founder of KP Asset Management. KP Asset Management specializes in mobile home parks and self-storage facilities across Indiana, Illinois, and Ohio. Paul's current portfolio manages around 500 units, and he syndicates and manages most of his portfolio in-house. Paul, welcome to the show.
Thank you, Andrew. I appreciate you asking me to be on.
Definitely. Can you start out by telling us your story and how you got into manufactured housing?
Sure. Long-time investor, mostly in stock market. Started investing pretty young. In fact, when I was a teenager, not even old enough to open up my own account, my dad took me to his office building downtown and introduced me to a broker that worked there. And they helped me set up an account to start trading. I was probably 16 or 17 years old because I know I couldn't open it myself. So did a lot in the stock market and always wanted to get into real estate, just never really put forth the effort to do it. Probably about 7 or 8 years ago, started getting really serious about wanting to get into real estate, started to earmark some of the money that I had in the market that was, enough that I could start purchasing some multifamily. So I pretty much started out like everyone else, kind of just educating myself, looking at single family, and then realized that probably wasn't for me, looking at multifamily. And I kind of stumbled across mobile home parks, and I actually dismissed it at first, but it kept sticking in the back of my mind, some of the things that I learned about it, which was the ease of operation. And though it's not easy to operate, it's typically easier than the multifamily. So I started looking into it, started educating myself on it. There wasn't much to be found as far as education back then. There was a little bit, but I bought my first property on my own and decided that I was going to self-manage it. And when I say self-manage it, I mean without even an on-site manager, take all the calls and basically learn the ins and outs of the business as much as possible over the first couple of years, so that by the time I decided to start speaking with investors about coming on board and purchasing more properties, at least I had a good background in managing the property, had a good feel for what was going on. And when I started to hire people to take over the day-to-day management of the parks, I at least knew what they would be getting into, and instead of them being able to, I guess, pull things over on me, I kind of, since I'd been there before, I pretty much knew what was going on and what needed to happen. So after that, purchased a second property with an investor. That went along for about 8 or 9 months, found some other properties, purchased, I believe, 4 more properties in the course of a year. Basically, we're up to 8 properties now. I've been doing it almost 5 years, and about 500, like you said, about 500 units. And overall, it's going really well. We've got everything from properties that we purchased that just needed a little bit of revision of management, and all the way to pretty good sized turnarounds.
That's fantastic, man. All of that.
Excuse me.
All of that in 5 years. That's pretty awesome, man.
Yeah.
For our investors that are the passive investors, the LPs, what would you say are the most important things that they need to look out for when investing into the mobile home park asset class?
For me, number one is the market, because it doesn't really matter what else you have. In my opinion, I think that the market really drives the asset to be successful or unsuccessful. You can certainly purchase a poor asset in a great market, but I would prefer that to a good, seemingly good asset in a poor market. And the reason is that if you purchase an asset that isn't performing quite up to what it should be, if you have a good market, you can always get it there. Whereas if you have a property that is in a not so good market, it may be going well today, but things can change in poor markets. And I define a poor market as somewhere that has, perhaps there's limited employment, or they rely too heavily on a single employer, which, as you know, can change very quickly, and it can have a dramatic effect on your property. And as far as purchasing properties that are maybe not looking so great at the time, if you have a good market, it's kind of like the old, if you build it, they will come. So if you have a good product to sell in a good market, you're going to be able to sell it. And it just becomes so much easier to do that. I would say of all of our properties, they're all in excellent markets. One of them is in an okay market. And really that one has been the one that's been the most amount of work. And I really, moving forward, I think that I'm going to stick with the really good markets. I mean, I like to see at least 250,000. I know a lot of people are chasing markets around 100,000, but even those, they could be good if you know the micro area. But if you have a market that's on the smaller side, you really need to take a look at it. Is that the only market in the area within, say, driving distance to jobs, like maybe 30 to 50 minutes, or is there another 100,000, 200,000? Because that can make a difference too. People will travel for good jobs, but I typically like to look at larger areas. Most of our portfolio now is in areas where there are, millions of people. So, those are just so much simpler. There's so much better as far as finding folks and being able to infill and occupy the homes that we have. The other thing that you have to look at, of course, is the demographics of that market, even on a micro scale, because when you get into the larger metropolitan areas, such as Chicago or Indianapolis, or I would imagine it to be true of most of the large metropolitan areas, you can have certain small sections that aren't great, as far as crime, or jobs, or you may have extremely low housing prices, and those can be challenging for operating a property effectively as well. And then, of course, there's value. So as you know today, it's very difficult to find value in this space. And I don't mean value by the asking price necessarily. It could be, but it could also be a seemingly overpriced by today's numbers property that is undervalued simply because of the fact that they have the rents are too low or something of that nature. So if you have a great area and you've got good value on your buy, then you should do pretty well.
Yeah. Would you mind sharing a little bit about what research you do, in regards to the market? Like what,
Sure.
For LPs, what I say is you should spend at least 5 to 10 minutes learning about, the top employers, and, maybe you could share a little bit about what you do when researching a market outside of just looking at population numbers.
Yeah, definitely. So some of the big ones are, of course, population numbers. Then you're also looking for what types of jobs, like you said, what types of jobs do these folks have? Is the employment diverse? Are these, even if it's diversified, are these employers, are they employers that are cyclical or not? Are they employers that are, heavily into one segment or not? Because all those things can be a bit of a red flag. So if you have diversity in both size and say segment, whether it's manufacturing or education, medical, it's best to have a very diverse employment, and to really understand who are the top maybe 10 or 20 employers, like you said, just taking some time to look at that and doing a little bit of background checking to see, if some of these employers are employing mostly, physicists and engineers, that's probably not the folks that are going to be living in your property if you're in manufactured housing, unless it's a higher end one. So you have to be careful too, not to look at the employers and say, oh, look, there's 10 great employers. They're not going anywhere. But most of the people living in your property aren't actually working for them. So you're looking for employers that, like Amazon and Walmart and, places that employ people in the, just your everyday Joe without a
service
college
industry.
education,
Yeah.
service industries, absolutely, whether it be fast food, things like that. So you're looking for that. You're also looking for the school systems, because it really doesn't matter how much money folks make or how much they can afford in housing. If you're going to be owning a property that is a family-oriented property, and it's not, say, a lifestyle choice or some sort of 55 and older community, everyone wants their children to have good schools. So I like to take a look at the school systems to see how the school systems really perform compared with surrounding areas, because if they don't perform as well, you'll probably lose a lot of prospects to the surrounding areas. We then look at things like, your average travel times for work, so it's nice to have places that are close. It's nice to have places that are looking at these areas to come into and to move their businesses to, not the other way around. So if there's a lot of businesses, and we struggle with this in Illinois sometimes, where whatever is going on in that state with taxes or whatever else it might be, you may have some great employers, but are these employers looking to leave? That can be dangerous. We then look at the pricing of comparable housing, and when I say comparable housing, I typically, we're looking at 2 to 3 bedroom apartments and 2 to 3 bedroom homes on the lower end of the scale. If you can get a 3-bedroom apartment for $600 a month, and you can purchase a 2 or 3 bedroom home for $65,000, it might be a little bit hard to move a manufactured home. So those are some of the things we definitely look at, and those are some of the things that will tell us whether or not the area is as good as we think it might be initially. And we always visit the area too. We just drive around and see what people are doing. Is this a place that people, is it bustling? Are people there, and they're going to stores, they're visiting the shops, there's lots of people. And then we kind of go around the area where the property might be located, and we try to see if there are some really, rundown, high crime areas. So we like to try and stay away from that as much as possible. But again, in some of the larger metros, 1 or 2 blocks, quarter mile, half mile can make a huge difference, and it's just the way it is. So, it doesn't necessarily mean that a property won't perform well if it's close to a blighted area, but if it's an area that we know really well, we'll be much more comfortable with it. So that's another thing, is we try to invest in areas that we actually know, that are somewhat near home, that we've visited, that we understand, and that we've spent some time in.
That's excellent. And where are you based out of, Paul?
I'm in the Chicago metro, so I'm in Northwest Indiana, and we do a lot in the Chicago area, and also in the Indianapolis area and the Springfield, Illinois area, because I've spent a lot of time in all 3 of those areas. I was born and raised in the Chicago area, spent a lot of time in Indianapolis, spent a lot of time in Springfield. And so, we're real comfortable with those areas, so we focus on those. And then the area we're in Ohio is really great, because it's got everything we look for. In fact, there's quite a few good metros that are really close. It's the Akron and Canton area, which is also very close to, I believe it's the Cleveland metro. So basically, lots of jobs, good paying jobs, steady jobs is what drives these metros to just be really good for us, because we're never short of finding folks that are able to afford the product that we're selling, and who are looking, because all of these areas also have shortages. So there's definitely a shortage of affordable housing in all of these areas. That too is key, because if you're seeing houses that are on average $200 and some $1,000, that typically indicates that you've got a pretty good need for affordable housing, especially if you're looking at the vacancy rates in the area and they're 10% or lower. That usually indicates a need for housing that's affordable.
Definitely. And I wanted to mention a couple of the websites, that passive investors, because a lot of them that I've spoken with won't actually go drive to every park that they're going to passively invest in, right?
Sure.
But they could take 10 minutes or so and check out bestplaces.net. That's a good website to kind of learn about a certain area, certain metro. In regards to schools, greatschools.org is a great website to use for that. And then city-data.com is another site that has a lot of good data on it about a certain area. So really interesting. One thing that I saw recently on LinkedIn is a map of the states and the population inflow and outflow. And I saw the state of Indiana, the population is increasing.
Right.
And then opposite to that, Illinois is
Right.
decreasing drastically. So
That's the fact.
you got any comments on that? What would you say? Have you noticed it in your business?
Yeah, definitely. It's definitely something that I've noticed. And in fact, I stated that we do invest in Illinois. We're very selective. Illinois is, for better, for worse, or I guess they're on a path where they're sort of at a point now where they've just gotten out of control with spending, and therefore their taxes have continually gone up and up and up. And I spent most of my life in Illinois, so I was one of those people that moved out of Illinois to Indiana. And when they raise taxes, and people begin to get to a point where they can't afford it, they look for somewhere that is more reasonable. And if they can just jump over the border to Indiana or Iowa, that's what they're going to do. And that's what they have been doing. It seems to me that has increased dramatically in the last 3 years. And here with this, with COVID, it seems to have even increased more so. In the area that I live, Northwest Indiana here, the amount of building, the amount of new construction is just unbelievable. I mean, every time you open a paper, you turn around, there's another developer adding thousands of homes, and they're selling so quickly. I'm actually a real estate broker as well, and I deal mostly with investment properties, but I do, for certain people, help them with their single family homes, and it's extremely difficult to buy anything around here right now. Something goes on the market, if someone calls you and says, hey, I'd like to go look at this weekend, and say it's Thursday, you basically just tell them don't bother, it'll be gone by the weekend, and it normally is. So people certainly are moving out of Illinois. That said, I don't believe that there is a long-term danger of investing in the Chicagoland area of Illinois and some of the larger metros as well, because Cook County is really one of the more difficult areas. Okay, so there's plenty to invest in outside of those areas, and there's plenty to invest in inside of Cook County. And many of the big players like Zeman and ELS, they still do invest in those areas, and they're doing just fine. And I think they'll continue to do just fine. The areas that are probably going to get hurt more are some of the outlier areas where basically, as people leave the suburbs, obviously the prices of the homes are going to go down, because you're going to have this maintained supply, if not increased supply, and you're going to have less people wanting to buy those. So a lot of people who may have had to live in a way off park in like Kankakee, Illinois, or something like that, but they work near the city, as the prices come down closer to the city, they'll probably move. So in my opinion, that could be a danger. But I think overall, I don't know that it's going to affect the mobile home parks and the manufactured housing near as much as it is single family housing. If I were investing in single family housing in Cook County right now, I might be a little concerned. But as far as the manufactured housing, we're talking about people that are on the affordable housing spectrum here with as far as they're purchasing, and they're looking for a good product for a good price. So as long as these properties do not price themselves out of the market, I think they can still continue to thrive over there. I do know folks that invest, that have parks in Illinois, and they're still doing fine. And they're a little concerned, and I've heard brokers talking about, if you own anything in Illinois, you probably want to sell it right now. And I understand that there's, not a lot of people super interested in Illinois, but at the same time, well, like Warren Buffett said, when other people are fearful, you should be greedy. And when they're greedy, you should be fearful. So if people are fearful and not wanting to purchase parks in Illinois, that actually may bring about some really good value over there. So
Yeah,
I'm
that's
not
true.
currently, I'm not
That's
currently
true.
looking to buy a bunch of parks in Illinois that, just to be clear on that. But, because I really like Indiana, really concentrating on Indiana in the Chicago metro, of course, because that's where all the people are going. All the people that are leaving Illinois, they're coming over here. And then I always really liked Indianapolis, done really well there. So I guess for what it's worth, that's my opinion on Illinois. But as far as Indiana goes, Indiana's a great state. If you get outside of Cook County, Illinois is more landlord friendly than most people believe. Cook County is extremely tenant friendly.
I have to disagree
Indiana,
with you there, Paul. I have a couple parks myself in Illinois, and every single one of them, when I have to evict somebody, it's just
really,
it's double the work in any other state. So
no kidding. Wow.
it really is, and it takes longer, and especially right now with the eviction moratorium going on, and I just feel
I'll
bad
give you
for
that one.
all those restaurants and other businesses that are being shut down basically by the state. I mean, it's unbelievable. But
well, I think that
Indiana, on the other hand, I've had a lot of
is
success
simple.
with.
Yep.
For sure.
Indiana's simple.
They're pro-business. They want people to come and do business there, and
they try to make it easy.
That's why they're growing. That's why they're growing.
That's right.
So,
absolutely.
Tell me this, Paul. What has been the toughest hurdle for you in the business thus far? I think you said you have 8 properties. Is that right?
Mm-hmm. I would say the toughest hurdle that I've come across so far is early on with partnering up with people is basically not spelling everything out to the detail that we should have spelled things out. For instance, we have a property in central Indiana, and the agreement was that the funding was going to come from a certain place, and that place with the investors basically dried up, and so there was no backup plan for that. So now we're looking at other ways to get that property funded, because the property is a turnaround. I wouldn't call it a super heavy turnaround, but it's a medium turnaround. And so, you and I discussed that property. In fact, that property has been the biggest challenge in that we're trying to find other avenues of funding, and they exist. However, they're just not as ideal as what we were hoping in the first place. So basically, I guess if I were to say the one thing that has been the biggest challenge is that I've learned the most from as well is when I set up, when I syndicate a property and I go to the investors and we discuss, how is this going to be funded, should always have a backup plan. Okay, so everybody basically puts in a pledge, or they even fund it at a certain point. But if that can't happen for whatever reason, what is the backup plan? And plan for that, because if we had planned for what the backup is, and the path we're actually taking, it's going to work out fine. But it was just, I think the biggest part of it was a lot of resentment over the fact that, man, this was supposed to go one way, and it's kind of not going that way. And yeah, this will work, but it's not ideal. So it's going to work, but it certainly would have been better if we sat down and said, okay, if that doesn't work, what our plan is, what's our plan B, and maybe even plan C, and how's that going to look? The other challenge that I would say is extremely high right now, and you'll probably agree with me on this, is finding contractors during COVID. It is unbelievable. And you would think it's because, well, nobody's working and they're all at home. That's not what I've found. What I have found is everyone's busy. Everyone has so much work. They're so booked out. It's been extremely hard. And because of the fact that we have so much value add going on right now, that is really pushing our schedules back significantly. So that part of it has also been a challenge.
Yeah, both good points. On the first point, so is it just one investor that you did a joint venture with on that acquisition?
Yep.
Gotcha.
Yep.
Yeah.
So
that could be very tough when you kind of run out of funds. And I've talked quite a bit about this. Is there's not a lot, if you buy a park that's in a good market, there's not a lot that you could do to completely just go bring your income down to zero, right? But if you're undercapitalized, it really straps you with what you can do, and it's a tough place to be in. I know some operators that try to use the cash flow to implement and do capex. Well, that's just a little tight. It's tight,
Extremely.
and it hurts your time frames, because you never know what's going to happen and when you're going to have a unit turnover. So that's interesting. Tell us, Paul, what do you think about the current state of the manufactured housing industry, and where do you see it going into the foreseeable future with COVID and all?
Well, I think that the state of the manufactured housing, it's similar to other types of housing. There are some hiccups with collections, things like that. I would have to say, from my personal experience and folks I've spoken to and things I've read, it's not quite as bad as the multifamily, but it's a bit challenging right now. And it seems to me that this second round of COVID has actually affected us more so than the first round. We had some tenants come to us, and typically we don't really get into payment plans or anything like that, but this was such a unique situation that we started working with a few tenants, and it worked out okay. Where we allowed them to pay, and they had to have something in writing, and basically said, we'll pay extra every couple of weeks or whatever it was. And so that worked out okay. We didn't have quite as much as we were expecting, because we didn't know what to think when all this started. But this second round, it seems like more people have lost their income. And the other thing, it seems that finding replacement income, whether it be from the government or from another job, has become more of a challenge. So our delinquency from the first wave of COVID was actually fairly low. And our delinquency on the second round is actually increased from that point. So we're still doing okay. It could always be better. We'd like it to be better, and we're actually making some changes to make it better. But giving us the ability to, where we would typically say, well, state you're in, if you don't pay, we're just going to go ahead and file an eviction. That whole process, we've had to rethink it dramatically, because in this environment, it seems that these folks, first of all, from the human aspect, they have nowhere else to go. If they've lost their job and they're kind of at their final place anyway, and they can't find anywhere cheaper. But I do believe that moving forward, the industry itself, I'm very bullish on it because of a lot of different factors. Obviously, one of the big ones is consolidation. That's happening dramatically. I'm sure you see it with searching for properties. It's nowhere near as easy to find them. When you do, the prices have gone up dramatically, but I still do think there's enough value left, whether it be in value add on the property level from rent raises, because I think that the raises or the rents are way too low in many properties. And as consolidation continues and some of these bigger players come in and they correct those numbers, it allows the smaller guys to correct those numbers as well, without pricing ourselves out of the market. I don't want to be the first one to go from $250 to $375 or $450, but I'd certainly will ride the coattails of 3 or 4 other properties that are raising their rents. So I definitely see a lot of value in the future. I think that we have to rethink what we're willing to purchase up front. So for instance, a lot of people aren't willing to purchase value. In my opinion, I'm willing to purchase value, but it just depends on what it is. It's based on risk and work. If I have to put up all the risk and I have to put up all the work, I'm not really willing to pay for that value up front. But if there's little risk and little work, such as rent raises, I'm willing to pay some of that value. So I think a lot of investors who look at purchase cap are going to have a very difficult time moving forward. But those who can look past it and who can truthfully build a Proforma that is reliable and achievable, and not from a broker who's trying to sell you the property, they'll probably do pretty well. Because I believe that the asset class, as the big players run out of 200 space properties to purchase, they're going to come knocking on the doors of the 100 space properties. And if you can get good with the value add, They're really not in that game yet. I think there are a couple big players who are dipping into that game, but for the most part, they're looking for turnkey properties, and there are so many out there that could be there but just aren't. And so I think that's where the mobile home park investors who are going to do really well going into the future are the ones that can truly evaluate something and look at the value of it and be able to reliably estimate or forecast what the property will do in 3 months, 6 months, 12 months, 24 months, and be willing to pay a little bit for that value up front. And also the ones who are able to take a property that is not running at full capacity or at the optimal management, and be able to turn those properties around. I think that's really where people are going to do well. But overall, the industry, it seems to me like it's going to keep going up, because it has gone up dramatically in the last 5 years since I started. And when you look at the fundamentals of it, there's just still so much room. It certainly hasn't gotten to the top yet.
Yeah, no, I agree with you on that point. Tell me, what are some of the strengths and weaknesses of KP Asset Management on the actual property management side of things?
So I think some of our strengths is, and this is always like the double-edged sword, where some of the property management companies, as they grow, they become slow. Okay, so we're still small enough where we can execute speedily, where we can make decisions quickly, where we can take a project, and if something changes, we can basically pivot very easily. Larger companies have a very difficult time with that. So I think one of our strengths is in our small size, because of the fact that, we can certainly look at things, make quick decisions. We don't have to go through layers and layers of management. We also try to run as lean as possible. If we have an individual working for us, we make sure that position is required. We make sure that person is working as efficiently as possible. We try to give them the technology. We're always looking at new technology to try to increase efficiency. We train our employees as much as possible and continually to try and make certain that they are always up on anything new, and we're never afraid to try new things, including things that are come from unlikely places. So we're always willing to listen to better ideas. If we have a system, a procedure in place, and we get feedback, we're always willing to look at it. It may not work, but we can always go back. Sam Walton was kind of the same way, where basically he was willing to try just about anything that was recommended to him from anyone. And we try to take that perspective on things and listen to everyone that works for us. And we also try to listen to our tenants. What are they telling us? We don't go out and decide that this property could use a playground and it's nothing but a bunch of 55 and older folks. We talk to the people and we try and find out what would bring value to them. One of the big pushes that we've got right now is we've got one of our managers looking at every property and basically trying to figure out what will bring value to the community. And when I mean value to the community, it means something that, of course, COVID notwithstanding, something that will bring the community together. Because we have communities where folks basically are isolated. They don't really talk to one another. They may have a friend or one or two in the park. And then we have other parks where everyone seems to kind of hang out and everyone knows one another. They visit each other. And the properties run so much easier when there's that community aspect. So we're really looking at opportunities for vacant spaces or just vacant areas in the property to try to have a community building type objects or whatever it might be, whether it's just a little covered area with some picnic tables or something that brings the community together. So they're all looking out for one another. They all know one another, and they're watching out for one another. And we're also trying to increase our communications with our tenants, because typically we had that funnel from the on-site personnel to the upper management or the middle management. And now we're trying to open it up so that there's more communication between the mid-management and the tenants, so that we can hear them and so they can feel heard, and so that we can act more quickly and make them happier and make them stickier. In reality is what it does.
Yeah. Tenant longevity.
It's a big
That's
one.
most important, right?
Yeah.
So tell us, Paul, what does the perfect mobile home park look like in your eyes?
Oh, wow. Perfect mobile home park. I would say the perfect mobile home park is in a metro of at least a million plus. Um, I would say at purchase, it has depressed rents that are somewhere in the neighborhood of $75 or $100 low. Maybe it doesn't have the utilities, the water and sewer build back, um, and it's got good occupancy and lots of tenants that have been there a long time. Most of them own their own homes and have them paid for outright. And the surrounding area has very high home prices. And I'd say that park has at least 125, 150 spaces. So at purchase, that would be the perfect property. Um, on the other side, from operations, say something we've owned a while, the perfect park is one that's obviously completely full. Most, if not all, the tenants own their own homes, whether it be through maybe some debt on the home or they've got them paid off. And again, going back to that community aspect, if I've not been to that park or if folks don't know me there, and I pull up and I step out and I walk up to say a home or something like that, or go look at something, immediately someone's on me. Who are you? What are you doing here? I've had that happen, and I've explained to the people who I am, and immediately they want to apologize, and I tell them, please don't apologize. This is what we want. You're watching out for your neighbors. I pull in here. You want to know who I am, what I'm doing here, because you've never seen me here before. That's fantastic. That's great. So I think that a property that has good tenants that are obeying the rules, they're in their forever home, so they're not going anywhere. They don't plan on moving anytime soon. They own their home. Um, you know, those are ideal. And either it's a larger park or it's very close to another larger park.
Yeah, that sounds like a heck of a park to me. I wanted to ask you about the manufactured home loans. I know you've done some of those with like PEP lending, or I know you had another company that you've used, or a credit union. Maybe could you share a little bit about
Yep.
your experience with them and kind of what that looks like?
Sure. Yeah, I think that if people are looking at putting third-party debt on properties, they really want to look into all the options out there. Pretty much everyone knows about 21st Mortgage, and they have a good product. But I will say regarding 21st Mortgage is that they have a good product depending on what area you're in. All right, so the tenant base, it may not work for 21st. So there are other options out there. We've had a lot of great success with Oxford, and some other lenders like Principal Equity Partners. They're all slightly different. The number of chattel lenders in the business has grown substantially. There are so many more today than there were when I first started, but they're not all apples to apples comparisons. So you really have to contact as many as possible and find out what the differences are. As far as I know, I believe Triad is actually working on coming out with a non-recourse product. So I'm really excited about that. And I'm going to keep in touch with them to see what that's about. But for the most part, they're all recourse at this point, and they're recourse in different ways. So for instance, you are underwriting the payments with 21st Mortgage, whereas you're underwriting the balance with Principal Equity Partners. So that's a big difference that you just, not saying one's better than the other, but it really has to be thought through. So if you have to pay off the home, depending on how much it is, you have to be prepared to do that. And also going back to what I was mentioning regarding 21st, it's not that they don't have a good product, but it can be a little bit tougher for some tenants to be able to get approved through 21st. So looking at other companies that look at tenants differently, that don't put credit as high on the list of qualifying, attributes, that's important as well. So like for instance, Principal Equity Partners, they look at job history and payment history. They really don't care about, for the most part, they really don't care about your credit history. And for the most part, most people that have family parks, these folks are not coming in with great credit. In fact, we've had to rethink some of our procedures as far as credit goes, because if you're trying to find a tenant and someone comes in and their credit is 480 and you've got it cut off at 500, you may be missing out on a really great tenant. But you really have to look close. If that tenant is, why do they have such poor credit? Working with lenders that are willing to do that, like Oxford and Principal Equity Partners, is really important if you're in an area where there's a lot of that. 21st is great because they typically will pay for more than will some of the others. They pay for setup, for instance, and where Legacy won't pay for the setup, they'll pay for the invoice and the HVAC. But so there's just so many different products out there. I think the most important thing is to learn as much as possible about at least a half a dozen of them that are available in your area, and then make more than one available to your tenants. So for instance, ideally we have 3 available on each property, because then if we like 21st the most, if the prospect is approved, great. If they don't, we want to have a fallback plan. And in reality, if we're trying to push something, you have to be very careful with some of the laws that are out there, where you don't want it to seem like you're steering them to a particular lender anyway. So it's a good idea from a liability aspect to have more than one lender available. Many people will underwrite these things themselves through either investment pools, which is fine, or on their books with their property. We do that when we have to, but typically I try to look at that as a stepping stone. So for instance, if someone comes out and is looking to purchase a home and they apply and their credit doesn't quite meet the standards of the lender, and maybe they don't have quite as big of a down payment as the lender would like, we might give them a short-term option to where they will lease the home from us for a limited time, and then they will have to purchase the property at the end of that term. And in the interim, what we'll do is we'll help them build the property management software that we use will actually report to the big 3 in order to assist tenants in building their credit. So if we can get them in 1, 2, or 3 years at the most to a point where that lender can give them that loan, that's ideal. But just understanding too that even if you have all these products, you may have to carry folks for a little while, depending on the scenario.
Yeah, no, I like that option where you say, hey, here's 3 lenders you can go to, pick, apply with all of them, right?
Yep.
It might help them out quite a bit.
Mm-hmm.
Okay, in regards to Proformas, what have been some of your Proforma mistakes? And then also, what have been some Proformas, items that you've been, right on with?
So I'd say the biggest mistakes with Proforma, and it's probably going to be the same with a lot of people, is schedule. I tell you, it's very difficult. My background is construction management, so I come from that industry. I did that for over 20 years, and I can tell you, it's very seldom that you get on a job that comes in under budget and ahead of schedule. It happens occasionally, but most jobs go beyond schedule. And so when we're doing a value add, the schedule has been some of the biggest oversights when trying to figure out how long is it going to take to do this or that. Another thing is when you're looking at your building your Proforma, for instance, sometimes you if the schedule is going to be farther out, you have to take certain things into account where if we've had certain vendors, for instance, where we had all these quotes up front, we built this Proforma, and then something happened to where their material costs increased dramatically, like with COVID. So you've got good numbers, but let's say your bids are only good for 30 or 60 days and you're coming back 90, 120 days later, and all of a sudden their asphalt has gone up 30% or wood has gone up 60%. Those are some misses. Can you fix those ones? It's you pretty much you can't, because you need a crystal ball to be able to fix that. But being a little more conservative on schedule is something that I've learned to do, and also on cost, to where if I'm getting bids, we certainly don't pick the lowest bids and throw those in the Proforma. That's a big mistake, because if you go through the process of vetting a contractor that's the lowest and they're a great contractor, fine. But many times what you'll find is that lowest price contractor really doesn't have everything in the bid, and you probably didn't build that out, or spend the time to vet all that out when you were building the Proforma. Some of the Proforma items that have we've kind of hit or exceeded. I think that for the most part, I try to be a little conservative on rent raises. And here it seems in the last couple of years, I've undershot that quite a bit, which is obviously a good thing, because of the fact that, it was hard 3 or 4 years ago to see how quickly the consolidation has driven rents upward. So that's a good thing. But, today I wouldn't count on it necessarily. I'd still be conservative on those fronts. But if you're putting together something that is a lot of value at a lot of construction work, make sure you're conservative on those time estimates, and make sure you're not just taking the lowest bidder. Not necessarily that you have to vet the contractors out, but maybe take the second highest or even the highest, depending on what it is. And I've always added at least 15% to every budget just for discovery, because discovery will kill you. You go in to replace a section of pipe, and you have to keep chasing it, and you always have to have some extra fluff in there. Another thing is that basically if you're moving a lot of homes in, you want to be very careful.
I was going to ask you, tell us about Infill. Do you manage that yourself? Do you have a team that manages that?
Yeah, I manage that.
How many
I
homes
manage
a
that
year
myself.
do you bring in?
So let's see. This year, here in the next few months, we'll probably have 24 homes coming in. I would say this year we'll probably have 50 homes moved in, maybe 60 tops. But when it comes to moving homes in, one of the things that early on I looked at was, okay, if we bring in 6 homes, we'll be able to sell these off and then utilize that money to start bringing in 6 more homes. That's a little dangerous, because of the fact that, as I was telling you before, if you get a bunch of prospects and they come in and they're all good with the 21st Century or Oxford or something like that, you get all your cash back. That works beautifully, no problem. The problem comes in when these tenants cannot get that financing, and you have to have a lease option. Well, now where's all that cash? Well, it's tied up until you get that third-party debt converted. So you have to be real careful with that. So I would always rather go to my investors and say that we want to basically fund most, if not all, these homes right up front. Now, if we don't need that money because of the fact that we're able to churn, that's great. But don't count on that churn until you really, really understand that market, maybe until you've sold a dozen homes in that market and you can see and you're sure that you can get that third-party debt to allow that churn. Because if you can't get that third-party debt, your only other option basically is to carry them until such time when you can get the third-party debt. So don't count on that churn too much.
Yeah, and it just can lengthen your time of the turnaround, if you have to sit around and wait. So,
yep.
Awesome, man. Well, Paul, thank you so much for coming on the show. How can listeners get a hold of you if they would like to do so?
Well, they can visit our website, and that's kpassets.com. It's plural, K as in Kelly, P as in Paul, and the word assets, ASSETS. And then my email is paul@kpassets, and they can get a hold of me that way. Or the company number is 219-595-2655.
Awesome. Well, thank you so much for coming on the show, Paul. It was a pleasure having you.
Thank you. I appreciate you having me.
All right, folks, that's it for today. Thank you so much for tuning in.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram @PassiveMHPInvesting for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.